Hello?
Yes, we can hear you.
Okay, I'm sorry about that. Please pardon me. I am a little technologically challenged, so let me. Hello?
We can hear you, yeah.
Oh, okay. All right. Good evening, everybody. Welcome to our second town hall meeting for the year 2023. This is hosted a joint collaboration between Adesado Old Boys Association, North America, and the Jacobs Abbey Global Institute, or JAGILS, headed by our own Pro, or Dr. Jacobs Abbey. So tonight, as you've all noticed from the flyer that we sent out, we'll be talking about taxation or taxes or tax filing with respect to this tax year, which is actually the 2022 tax year. I know some people have already filed their taxes, some have already gotten their refunds and things like that. But there's also a whole lot of people who haven't had a chance to file theirs yet. And we believe that this will be the right time to address this topic. I hope everyone came with questions, because one thing is, as a responsible citizen, as you pay your taxes and things like that, you also want to make sure that you're also not giving the government money that is rightfully due you. We don't want you to leave anything on the table. So this is something that we thought about, bringing to our membership, and not just Adesado Old Boys, but our family members and our friends and everybody else who's online tonight with us. So actually, before I say anything, let me go ahead and officially welcome everybody who is not a Santaclausian who is also on this call. We really appreciate your presence. It's your presence on the program that makes it, worthwhile. So we appreciate you and we want to welcome you. I'll just go ahead and introduce our speaker for the night. I don't want to, delve into his field. This is something that way above my pay grade. But we have our very own Professor Atuahene, who is a certified public accountant, and also the treasurer for AOBA North America. This man is very knowledgeable in what he does. If you've listened to any of his presentations at our Congress and everything else we've done, he takes his time. He puts a lot of effort into everything that he does. He knows his stuff. So you are actually at the right place at the right time. And I believe that if you pay attention to the things that he brings this evening, that he will save you some money, not just you, but your family as well. I believe that it's time for us to, take advantage of everything that's rightfully due us and not leave any money on the table. So with that said, actually I think he's a man who also wears, several titles. He's also the principal of the Urbana tax group. I'll let him introduce himself and, tell you all this stuff. But without much ado, I want us to all welcome our brother and a fellow Santaclausian, a proud Santa, Professor Edward Atuahene.
Thank you, Dr. Leo, and thank you, Dr. Abdi, for having me. Around this time of the year, I'm so busy, but when Adesado College came calling, there was no way I could turn this opportunity down to come and talk to you. So it's a privilege to be here with you today, and I'm glad to be here to share some knowledge that I've acquired over the years. The first disclaimer that I want to tell you all is that I'm not here to make anybody a tax expert, okay? So we are not going to go out of here becoming tax expert and being CPAs. But what the goal of today's meeting is to make sure you understand what your tax returns means, right? There's been several instances where we get new clients and we ask them for their prior year tax returns, which has been signed by them. And then we ask them if they understood what they signed. And they're like, no, I just got a refund for $5,000 and I'm happy. I'm like, oh, But did you take your time to read what you signed? And they'll be like, nope, I had no idea. Did you give contributions to the YMCA or me for $15? Like, no, I didn't give no contribution. But why you put it there? Okay, my tax preparer put it there. All right. So the goal of this meeting is kind of go through your tax returns, take a look at it, understand some things before you sign them. Ironically, if you give your taxes to somebody to prepare for you for a fee, it's supposed to have the person's name on there. But most of the time you see it saying self-paid. So self-paid means you paid it yourself, and the onus is on you to understand what you did. And then also with an influx of so many tax software, we know that a lot of people are doing their own taxes. So there's the need for us to understand what we do, okay? So that's my first disclaimer. I'm going to go ahead and share my screen. If I can.
Yeah, you can.
If I can figure out how to do that, Pro.
Yeah, you have access, so go ahead and share.
Can you see my screen?
Not yet, he hasn't come yet.
Let's try it one more time. There you go. Okay.
Yeah, there you go.
Can you see it now?
Yes, it's loading. Yep, you can see that. If you want to zoom in a bit.
Can you see it now?
Yes.
All right. So like Dr. Leo said, this is related to the 2002 tax year. So that's why it's got the year 2022. So if everybody's confused what we are doing, even though we are filing the taxes this year, it's related to last year. A little bit about me. Leo said, I'm the principal of Urbana CPAs. It's a small and pop shop, just came to get home last year. I'm also a tax consultant with Intuit Table Tax. And as some of you may know, I've been an adjunct professor at Australia University and a graduate teaching assistant at the University of Maryland, Smith School of Business. With regard to my educational background, I went to the best school in the whole world, which is at the Santaclausian College. I'm a proud product of Santa 96, and I studied general arts. So from there on, I proceeded to the University of Ghana Business School to do finance and headed on here to the United States around 2002. Went to Montgomery College, dived into accounting, and then went on to the University of Maryland to study accounting in 2010. All right. I'm also a CPA, and I've got a couple more certifications. I'm a chartered global accountant. I'm a certified internal auditor, and I'm a certified fraud examiner. Right, let's dive into why we are here today. A couple of things that I want you to be aware of. The first thing is the W-4. When it comes to your tax withholding, the first thing that you need to be aware of is your W-4s. One may ask, what is a W-4? So if you remember correctly, the W-4 is the forms that you filled when you first got your job or when your status changed on your job, all right? If you are part of the old school, there used to be personal exemptions on the W-4 and all these different things that you could claim, but the W-4 has been changed. Why is this so important? The W-4 determines the amount of withholding your employer sends to the IRS, okay? So this is very important. It determines the amount of withholding your employer sends to the IRS based on what you tell them. The second, which may be aware of if you were or somebody, is the W-2s. At the end of every year, your accumulated earnings is gathered on a form or your W-2, and a year-to-date statement is given to you, and that forms the basis of filing your taxes. The next forms that you need to be aware of is the Form 1040. that is the individual tax returns that we are here to learn about. So if you are an individual and you filed taxes before, you should be aware of this form. This year's tax deadline is April 18th. The usual day is April 15th of every year. However, April 15th falls on the weekend this year. And April 17th, which is the Monday, is a holiday in DC, which is recognized by the IRS. So they've given us an extra day to get our taxes filed. The one thing that I also want you to know is that if you're not ready to file your taxes by April 18th, you could also require an extension by filing for an extension. By filing for that extension, it gives you an automatic 6 months, right? So it goes from April 18th to October 18th. And then the last fact that I want you to know is that not everybody is required to file taxes. But in order for you to claim a refund, let's say if your employer withheld some taxes and they were not supposed to, or if you fell below the threshold for filing taxes, you must file to get that refund back from the IRS. Okay, so I'm going to go through the slides and then we'll reserve our questions to the end of the discussion. Is that fair?
That's right.
All right. Next thing that I'm going to talk about is the basic tax formula. It looks very scary on the screen, but this is what taxation is about, and it's a very simple process. Okay, I spoke about the W-2. So the first item that you see here is your gross income. It's what is allocated on your W-2. So if you have your W-2, those who are your tax ready or those who want to file, the income comes in box 1 of your W-2. Okay. If you got a 1099 NEC or a 1099 miscellaneous, that also comes in box 1. But the most important part is your gross income. All right. And then there's something that we call the above the line deductions, or deductions to arrive at your AGI. For most tax preparers, the most important number is the AGI, which is called the adjusted gross income. This can be found on line 11 of your form 1040. And that is what is used to calculate your tax liability. So out of your AGI, which is this number, the IRS allows you to deduct a standard deduction or an itemized deduction, okay? The standard deduction, as the name suggests, is standard. Or if you have a listing of the items that you want to deduct, we call it itemized for a reason, because it's a listing of everything that you want to deduct, right? I'm not going to go into the qualified business income deduction because this presentation is about individuals. So if you take out your standard deduction from your AGI, it gives you what we call your taxable income, okay? And then you multiply that by your tax rate, and then it gives you your gross tax liabilities. And then out of that, you take out your credit, and that determines if you are going to get a refund or if you are going to owe the IRS money. Historically, most people think they're always supposed to get a refund when they file taxes. And that is the reason why when you go to some tax preparers, they're under severe pressure to put things on there that they're not supposed to make sure that customer goes happy. But you don't want to be in that situation. Like I said earlier on, you need to understand your taxes, especially for those who buy tax software online with regard to TurboTax and Tax Act and all these different software that are available. All right. So we want to go deep to some of the things I spoke about, which is your gross income, adjusted income, the standardized or itemized deduction, and some credits. This is the form 1040 that I spoke about. Everybody here who has filed taxes before on an individual level should be familiar with this form, okay? These are the pages 1 and page 2 of your tax returns. So if you go to your tax returns and you pull it up, you should be able to see this form. It's a very, very simple form, although it looks very complicated when you look at it from afar, especially if you don't understand what you're looking for, right? If you look at the top portion of this form, it gives you your filing status. Right here in the United States of America, we do have 5 filing statuses, okay? You are either single, married filing jointly, married filing separately, filing as head of household or filing as a surviving spouse, which is if you lose your spouse, okay? So single, married filing jointly, married filing separately, head of households if you have any dependents, or qualifying widow or widower. The next section gives you your personal information, which is your name, your social security number. If you're filing a joint return, your spouse's name will be on the line, on the next line, and their social security number and the addresses, okay? And they've kind of added this simple part that talks about if you purchase cryptocurrencies or other digital assets. The next line here talks about you being blind or being born before a certain age. You get additional credit for that if you are blind or if you are over a certain age. And then this is the dependent section, okay? So if you have kids or any dependents that are relying on you, their information goes down here, all right? Earlier on, I spoke about gross income. The gross income, your W2 go on line 1, all right? Look on your W2 or if you look on your Form 1040, there will be a number in line 1 if you earned income from your employer. And then all other ancillary income that comes with your gross income goes to this line. And then that determines your adjusted gross income, which is very important on line 11. As a matter of fact, the IRS will not allow you to e-file your tax returns if you don't know your AGI from the previous year. So it's a very, very important number, especially if you want to e-file. You need to know your adjusted gross income. So like I said earlier on, out of your adjusted gross income, you are allowed to take the standard or the itemized deduction. You cannot take both, right? The rule says you've got to take the greater of the standardized or the itemized deduction, all right? And that gives you your total tax. And then you take out your tax credits, which is on page 2, your child tax credit and other credits that you are given. And then the withholding, which comes from box 2 of your W2, the withholdings that were held from your paycheck every 2 weeks. You know, if you make $2,000 every 2 weeks, we all know that you don't get $2,000 into your direct deposit. You get maybe around $1,200. So there are several withholdings that come out of your paycheck. And one of them is the withholding that goes to the IRS, okay? So depending on how much tax you have and you're withholding, that determines if you are going to get a refund or if you are going to owe the IRS. And this bottom part, if you want to pay, get your refund via a direct deposit, or if you want to pay through a direct deposit, you put your information here and then you sign here, okay? For anybody on this call who is paying somebody to prepare their taxes, you need to be very aware of what goes here, okay? Be very aware of what's on here. Don't just collect your tax and put them in the and away somewhere, then make it an annual routine of just going to them and doing it. Make sure if you are paying somebody to do it, make sure you sign in here as a paid preparer. Why is that so important? Because if it says self-prepared and you are paying somebody to do it, that person is free of any liabilities of anything that they put on your tax return that you did not authorize them to do, okay? Like the first example I gave you, people will go ahead and put in medical expenses that the taxpayer did not tell them to do because there's a huge misconception that people have to get refunds when they file taxes. And that is not the case. Right, so let's go through the different categories of gross income, adjusted gross income, the standard deduction, and the credits. So the IRS defines gross income as any income from any source, okay? Even if you engage in an illegal activity, such as smoking, everything, though it's illegal, the IRS expects you to pay tax on it. And later on, the law enforcement will deal with you. But it's any income derived from any sources. The income could be in a form of cash, or it could be in a form of fair market value for a property or services received. What does that mean in plain English? All right. Let's say if I do a job for you, and in lieu of you paying me cash, you decide to give me a condo, or if you decide to give me your car, that is considered income, okay? So the IRS expects you to pay the fair market value of the property that you've received for the services that you've rendered. In this day and age, people are paying people with Bitcoins and all these different cryptocurrencies that are hanging around. All those things are taxable income. So with the gross income, those are also divided into 4 different categories. All right. We have your salary, which everybody who works for study comes on your W-2, 1099 NC, your pensions, your unemployment, Social Security benefits, those are considered ordinary income. And then those who have savings accounts and investments, at the end of the tax year, you do get some form called 1099 INT, which is called portfolio income. So these are your dividends and your interest, okay? If you have a savings account, typically your bank will send you a 1099 INT, or if you have an investment account, your investment broker will send you a 1099 DIV. The third part of income that we'll talk about is called passive income, right? If you're involved in real estate or renting properties, we call them passive income because you are not actively involved in the management of the company, something that you do on the side. If you're involved in partnership, if you do have royalties, those are also considered income. And the last but not the least is your capital gains, okay? The sale of assets for a gain create capital, and one do that for 1099B or a 1099S. If you've sold a house before in this country and you sell it for a gain, right, there are exclusions with the gain. If you are single, you are allowed to exclude up to $250,000 of those gains. Those are tax-free income. And that is one of the benefits for buying a house in this country, okay? If you are married filing jointly, the exclusion doubles to $500,000. Any amount of gain in excess of $250,000 or $500,000 is taxable income to you, okay? And the tax is determined based on how long you've held the property. If you've held it for less than 1 year, it is called a short-term capital gain. If you held it for more than 1 year, it's considered a long term. And it is so crucial because your tax rate is based on how long you held it. Okay? If it's a short term, the tax as ordinary rate, but if you hold it for a longer period of time, you get a very preferential rate, which is much lower than the ordinary rate. How do we derive our adjusted gross income? As I mentioned earlier on, this is the line 11 on your 1040, which is so important. So if you look at your gross income, there are certain items that the IRS will allow you to deduct out of your gross income to get your adjusted gross income. Okay, so listen to the terminology. We have our gross income, and then we have our adjusted gross income. So you adjust your income to get your adjusted gross income in a simple way. Okay, you adjust your gross income to arrive at your adjusted gross income. What are some of the things that you are allowed to deduct from your gross income to come to your adjusted gross income? If you are a teacher, right? If you teach and you spend some money on supplies, the IRS will allow you to deduct some of the supplies to arrive at your adjusted gross income. Contributions to certain retirement accounts, which is your traditional IRS, those are tax deductible, okay? So that will come out of your gross income to get you to your adjusted gross income. For the past 2 or 3 years, I haven't paid my student loans, right? Because of the student loan deferment. But if you pay your student loan, any interest that you pay on those student loans is also deducted from your gross income to bring you to your adjusted gross income. Student loan interest paid. Of course, there's a limitation on that and there are caps on that, but that is a discussion for another day, okay? There's a limitation on income as to how much you can deduct, and then there's a cap on how much you can deduct from the student loan interest income. Some of you have health savings account through your employers, or some of you buy it on the open market. Those are also tax haven. Why? Because you are allowed to buy an HSA on FSA pre-tax dollars, okay? As long as you are using the funds pay for medical expenses, those are tax-free. So it's considered a tax haven. And the reason why the adjusted gross income is so important is you could have a gross income of $100,000, okay? And then if you take some of these adjustments, traditional 401k or traditional IRS, and you take advantage of the health savings account, all of a sudden your adjusted gross income can drop from $100,000 to maybe $65,000, okay? And that will put you in a lower tax bracket for you to pay less taxes. That is why some of these are considered tax havens. For those who have their own business, we are allowed to deduct our health insurance premiums that you pay, and then one high for FICA. We're not going to go into that. And then if you all remember, we used to have the tuition and fee deduction as an above the line item that has been canceled. Moving expenses has also been eliminated except for military folks. So we used to have moving expenses. If you move from one state to another, you used to be able to deduct it on your taxes. That has been canceled. And then for those who had a divorce decree and are supposed to pay alimonies, we used to be able to deduct that on your taxes. But that has also been eliminated, unless of course, the agreement was in place prior to 2019. So if that agreement was in place, then you're allowed to deduct the alimony that you pay to your spouse. Of course, the IRS is not going to let you deduct something that they are not going to get a benefit for. So on the other side, the receiving spouse is also allowed to count this as taxable income, right? So you are taking a deduction, the receiving spouse takes get taxed on the alimony that she or he receives. All right, a couple more slides and then we'll open this up for questions and answers. After 11, remember about the standard for item deduction. The good news is that with the elimination of the personal exemption, remember you used to be able to claim your children, you claim 2, 3, 4, 5, that has been taken away. The standard deduction rate has kind of gone up or doubled. So I was reading a statistic that in 2021, about 90% of taxpayers who filed taxes took the standard deduction, okay? Because of the higher rates for the standard deduction, the needs for itemization has kind of gone down, all right? Because let's take this example, looking at this, if you are getting, if you are married filing separately, or if you are single, you are getting a standard deduction of $12,950 for 2022 tax year, okay? For you to get a benefit from itemizing your deduction, you have to accumulate expenses in excess of this amount for this to be beneficial. You've got to get medical expenses, you've got to have donations, your mortgage insurance has to be, all those combined has to be in excess of this amount for you to itemize. So the need to itemize has kind of gone down with the increase in the rate for standard deduction. If you're married filing jointly, that amount doubles to $25,000. So all of a sudden, you've got to stretch to be able to itemize, okay? You've got to stretch, you've got to give more donations. You have to have a big health bill for you to be able to itemize, contribution credits, all those things. So it's become very difficult. So it's only 10% of taxpayers that were able to itemize in the year 2021. Head of household also has a tax advantage because, as you can see, there's about a $7,000 difference between married filing, separate or single, and head of household. And then these are items will allow you to itemize, okay? So you either claim the top portion, which is your standard deduction, or you itemize. So for those of you with mortgages, you can itemize your mortgage interest paid for up to 2 houses. So at the end of the tax year, your mortgage company will send you a form. I believe it's 1098 form that will show you how to fill in your tax forms, okay? 1098, that's what is sent to you. You can also itemize your property taxes, your state and local income taxes or sales taxes, And then you can itemize your medical expenses, which is in excess of 7.5 of your AGI, okay? Like I said, I'm not trying to make you tax experts, so we are not going to go into details, because the more I try to explain this, a lot of people who are not familiar with this will get confused. But if you have medical expenses, for you to be able to get the benefit of the medical expenses, remember the AGI number that we spoke about, line 11? Your medical expenses will have to be above 7.5% for you to get the tax benefit of those medical expenses, okay? So not every medical expense is deductible because it might fall below the threshold. Charitable donations. Any charitable donations that you do is part of your itemized deduction. As you all know, I've been the treasurer for AOBA North America for the past 8 or so years. And one of the letters that I sent to you, if you give us donation, is that your donations with AOBA North America is tax deductible, okay? This is the reason why we send you that letter. Of course, if you're itemizing any amount that you give to us, any amount that you give to your church, if your church is a registered 501c3 organization, any amount that you give to the Salvation Army, including items, you could give them, you could be used, any that you give goes on tax form as itemized deduction. To run the tax credit. So after you've itemized, you are allowed to take some tax credits, right? The most common tax credit that is available to us is called the earned income credits. And then for those with children, we do have the child and dependent tax credits. We also have adoption tax credits, education credits for those in school, the Learning and American Hope Opportunity credits. We do have foreign tax credits. So in the whole world, there are 2 nations in the whole world that tax their citizens based regardless of where they live, okay? And the 2 nations in the whole world is the United States of America and Eritrea. So that's a fact about % of you did not know. So if you're a citizen of Eritrea and you're a citizen of the United States of America, as long as you're a citizen of those 2 countries, regardless of where you live in the world, you are required to pay income taxes, okay? But as a citizen of the United States of America living in, let's say, England, or living in Ghana and working in Ghana, of course, if you work in Ghana or England, you're also going to pay taxes on to the government of UK or the government of Ghana. So what the US government says is that, okay, in order to avoid double taxation, because Ghanaian government is taxing you or the UK government is taxing you, we are going to give you a foreign tax credit, right, to offset those taxes that you paid, all right? So that's where the foreign tax credit comes in, because we don't want to tax you twice, okay? Retirement saving contribution credits do have a lot of general business credits for those who are business owners. And then we have something that I call the green credits. This is my personal term, right? So if you have an electric vehicle like a Tesla, if you install panels house, you are allowed to claim credits for those tax returns, right? This government's incentive to make sure we are going green and everybody is, fighting to the law to save the environment. All right, 2022, specific to 2022, for those who filed already, you may have noticed that your tax returns are lower than what you got in 2021 and 2020. Or if you owe money to the government, you owe a lot more money than what you have in the previous years. Why? So many things have changed, right? Because of the COVID and because of how the economy was going down, the government put in place several things to kind of hold us together and give us additional credits in 2020, 2021. And then all of that, certain things have come back to normal. So they've kind of taken those away. And some of the things that has changed, all right? The first one is there was no stimulus check, all right? A lot of you got stimulus check based on your tax filings from 2020. There was no stimulus check last year. So that is done. For those who have children, you notice that the child tax credit has reduced to the pre-COVID levels, right? During COVID, the child tax credit went up to $3,600 per child. It has come down to $2,000, okay? It has come down to $2,000 and it's no longer a refundable tax credit. Earned income credit has also been reduced, right? So the maximum amount of credit for the last 2 years, that amount went up to $1,500. That's why everybody was getting so much money on their tax returns. That has kind of come down. There's the child and dependent tax credit. All right, so this is different from the child tax credit. This is a child care credit. This is if you and your spouse are working and you take your child to register or recognize daycare, the amount of money you pay to the daycare, you can deduct on your taxes, okay? During COVID, you could deduct up to $8,000 of those expenses. That has been brought down to F. When I say it's been brought down to F, it's been brought from $8,000 to $2,100. So as you can see, that's a big change from the prior years. Charitable donation, I don't know if you all realize, on the last 2 years tax returns, you are allowed to claim $300 without showing any proof, okay? For those who did the self-filing, you could go in and click $300, I gave donations, and you didn't have to put any name on there, okay? If you are single, you are allowed to deduct $150 if you are single, and if you're married filing jointly, $300. For this tax year, which is 2022, when you put in a charitable donation, you have to list the name of the organization that you gave the funds to, okay? So for any of you who are planning to give donations to AOBA to take care of our scholarship program, like I said, we are a registered 501c3, so you can give donations to us and then you can use it to file your taxes. We'll give you all the information that you need to file those taxes. The last item that has changed that I want to talk about is that we've seen higher standard deductions due to inflation. So if you're married filing jointly, there's an increase of about $800 from the prior year. So in 2021, the standard deduction was $800 less if you're married filing jointly. If you are single, it's been increased by $400 due to inflation. And then for those who qualify as head of household, it's been increased by $600. Okay. And then finally, this is the tax bracket. Don't let this scare you. What this simply means is that depending on the income and your filing status, this is the taxes that you pay, okay? So, and it's not as straightforward as it looks, okay? Because the US system uses a graduated tax system. So you cannot just take this chart and say, oh, I made $170,000, so my tax rate is 32%. No, it doesn't work that way. I mean, you know how we are as Americans, right? We try to make things complicated. So let's assume that you made $170,000, okay? This is how this will work. The first $10,000, if you're single, will be taxed at a rate of 10%, okay? And the next $10,000 and $41,000 will be taxed at a 12% rate. The next $41,000 to $89,000 gets the higher rate of $22,000. And then the next $89,000 to $170,000 get taxed at 24%. And then the last one get taxed at 32%, right? So it's called a graduated tax rate. So do not assume that I'm single and I made 170K 051 and I'm going to get taxed at 32%. No, it doesn't work that way. Okay. If you're married filing jointly, the first 20,000 get taxed at $10,000, right? For you and your spouse, right? Of course, if you and your spouse are working, your income doubles. Okay. The next 20,000 to 83,000 get taxed at 12% and so on. If you're married filing separately, it's similar to being single, same way. And if you're a head of household, this is your tax bracket, okay? Very, very easy. I mean, I've had clients who call me and do their own taxes by hand. They don't use a software because they know what to do. They know how much credit is available to them. They know their tax brackets and everything, and they calculate their tax returns, and then they go ahead and use a software and try to reconcile the differences, you know? And I'm like, I mean, I'm never going to do this manually, but I don't know why people do it. People do things for different reasons. So this is the end of the presentation. We are right on time, 30 minutes, and I'm going to leave the rest to Dr. Pro and Dr. Writer for question and answers.
Thank you so much, Ono. If you can release the screen. Thank you so much. Guys, this is an amazing presentation from Professor Atuahene, and I know Dr. Writer is ready to take us through. So, Dr. Writer, over to you.
Thank you, Prof. And thank you, Prof, for an awesome presentation. Like I said, I mean, I guess the proof was in the pudding. This was very detailed, and I think we've already learned a lot. We would want to open the floor now for questions. If anything didn't sound clear to you and you need, another quick run through, or if you have a question that wasn't addressed during the presentation, this is the time for you to bring it to the floor, and Prof will take care of it for you. So officially, we've opened the floor for questions and answers. Thank you. Oh, and before that, you can either ask it live, or if you, for some reason, want to type it in the chat section, you can do that as well. So please feel free to ask your questions. Thank you.
All right. I think we have Dr. David Yankee. Dr. Yankee, you can go ahead.
Okay, thank you for allowing me to ask this question. Prof, if you have minor kids that work, right, and you are claiming them, you mentioned that not everybody is supposed to file taxes. So my question is, they receive W-2s, but probably their income was below $1,000 or something thereabout. So what happens? Do they file? They are minors, they are below, 17 and stuff like that. So what happens to theirs and what happens to ours?
Prof, it looks like you are muted.
That's a great question. Thank you so much, Dr. Yankee, for asking that question. All right, so do you guys remember that I spoke about the standard deduction? So the standard deduction is about $12,950, all right? So if you are single and you make income below that amount, you are not required to file taxes. As a matter of fact, that's one of the group that is not required to file taxes, regardless of your age. Okay, the standard deduction is standard. Everybody gets the standard deduction. So if you are single and you make income below that amount, you are not required to file taxes. With my consulting engagement with double tax, sometimes you get people calling you that they know that they're not required to file taxes. However, they want to file taxes. Okay. It's okay to file the taxes. The IRS will not stop you from filing taxes, even if you're not qualified to file the taxes. But if you make that amount of income and you want to file, it's up to you, but you're not required to file taxes. However, for your specific case, if they made $1,000 and there's a withholding in box 2 on their W-2 and they want to claim that money back because they are not required to file taxes, they can go ahead and file and see if they'll get the money back. Okay.
All right. Thank you so much, Prof.
Follow
think we
up. Follow up. No,
Okay.
sorry. So I know you said the 12,000, but if the person is self-employed, right, and they make that amount, how does it affect their social security and stuff like that? Because they've not paid.
If the person is, thank you so much for the follow-up question. If the person is self-employed, that's a different scenario altogether, okay? Because if you are self-employed and you make that amount, then you are required to file taxes, because with a self-employed, there's no tax withholding. You are proactively required to file your quarterly taxes or your quarterly payments. So if you are self-employed, it's a different scenario. Self-employment has different rules. If you make profits from your business as a self-employment, then you have to look into the filing requirements. They do also have minimum thresholds, which I can't tell you off the top of my head right now. But if you meet those thresholds, if you go above those thresholds, then you have to file your taxes. As a matter of fact, self-employment, you have to pay an extra tax for being self-employed.
Got you. Thank you so much. Sina, yes.
Thank you very much. Prof, thanks. And Jake, thank also for this opportunity. You did mention the 5 categories that one can file: single, married jointly, married separately, widowed, and I think the other one was head of household. If you are married and one files head of household, what will the other person file?
So if you are married, you have 2 options. You can either file married filing jointly or married filing separately. Those are the 2 options that are available to you. Head of household is available for single parents who are taking care of the kids, okay? So if you are married, you are legally married, right? And the IRS states that you have to be married by the 31st of that month, of that year. So let's say if you guys got married on the 31st of December 2022, then you can claim the whole year as married, but you cannot be married and file head of household.
Thank you so much.
Thank you very much. That's good.
Okay, great. Agusa Boche, you have your hand up.
Yes, I have a question, Professor. So with regards to our organizations paying for our tuition, do they consider that as an income when we file taxes?
All right, so for the tuition reimbursement, are you talking about the tuition reimbursement that you get from your job?
Yes.
Yes, so for the tuition reimbursement, there are 2 things, okay? If your company is reimbursing you for up to 5,225, that is tax-free, okay? That is not taxable income.
Okay.
Any amount in excess of 5,250 is considered taxable income to you, okay?
Okay.
But if they are paying for your tuition, up to that amount is tax-free.
Okay. I have another question, Professor, please. So for single parents who file, are they able to claim like the head of household themselves and the child if they have like 1 child? So can you say you claim for 3 people?
Yeah, so for a single parent, you can use the head of household filing status, okay?
Okay.
You are allowed to use the head of filing. So you become 2 people, you and your child.
Okay.
But of course, there are different rules that will apply to you to use that head of household. It's not just having a child, okay? You've got to go through the questions. And once everything fits within that category, as a single parent, you can file as either married filing separately because you and your spouse have separated. You can file as single or file as head of household. So there's 3 things that are available to you. You could even file as a qualifying widow if you've lost your spouse in the last 2 years, okay?
Okay, thank you very much.
There's a question in the chat from Captain, and it says that is a tax bracket based on gross income or the adjusted gross income?
All right, that's a great question. Remember the chart that I showed you all, the formula. You know what? It's so hard to share the screen. I'm not going to share. Remember the income tax formula. So we start with your gross income, right? You start with your gross, then you take out the deductions to arrive at your adjusted gross income, right? And then out of the adjusted gross income, you're allowed to take a standard deduction. If you are single, it's $12,950, or the itemized deduction. Okay, so let's put some numbers in here. Let's play with some numbers. Okay, when everybody hears that I'm an accountant, they think I'm very good in math. But as Prof can attest to, I was so horrible in math in Adisco. but let's put some simple math in here. So let's say your gross income is $10,000. Okay, $10,000. Simple example. And then you had adjustments to reduce your gross income. Let's say $2,000. Okay, so all your adjustments come in. You paid student loan interest for $2,000. Now your adjusted gross income is $8,000. Does it make sense?
Okay, I can ask the question.
So out of your adjusted gross income, you're allowed to take out either a standard deduction or an itemized deduction. For this example, I'm going to keep it simple. So you're going to take a standard deduction instead of the $12,000. You're going to take a standard deduction of $4,000. Okay. So you take out the standard deduction of $4,000. Now your taxable income, right? Your tax rate is $4,000, and that is what we use to calculate the tax brackets.
Gotcha.
So let me walk through it again. You made gross income of $10,000. You took out deductions for $2,000 to arrive at $8,000. You took a standard deduction of $4,000. Now the amount that you are going to be taxed on is the remaining $4,000. Okay, so let's assume the $4,000, you fall into the tax bracket of 10%. Now the 10% is going to be applied to the $4,000, and then you pay taxes on that. Even with that, if you have any credits, remember the credit that we spoke about, the child tax credits, the earned income credits, you can also take those credits to reduce tax liability.
Gotcha. All right, great. So another question here, it says, thank you for this insightful program. Can you explain a little bit what qualifies a person to file as a head of household versus filing jointly? I think you've explained it some way already, but if you can.
Yeah, so the head of household is, you are single, you have dependents that you take care of and all blah, blah, blah. And then the married filing jointly, you know, a lot of people ask that why would married couple decide to file separately? Okay, we are married, we are not fighting, we are not divorced, there's nothing going on, but we decide to file our taxes separately. So maybe I'm going to take the question from that angle and show you why people will decide to file separately, and then that will make sense why. Because it's not automatic that if you live with your spouse, you want to file taxes with them, okay? So let's say you go into a marriage and your spouse come in with a lot of debt, or they owe the IRS a lot of money, which is their debt that they brought into the marriage, and you don't want to be involved in that. One of the reasons why couple will file separately is for that reason, because if they join the returns and they have a refund, the IRS will keep the money. The money doesn't come to you, right? You incur the debt when you were single, you were on your own. So some couple, I don't know, I don't see that among our people, but typically, if you bring a debt into the marriage, it's your debt, okay? Also, there are some couples who like to hide money. You know, they make so much money and they want to hide it, and they don't want their spouse to see. They can decide to file separately. Some people have complicated tax situations, you know, they can decide to file separately. And then all these different reasons, even though we are still married, and then we are, you know, living in the same household, but when it comes to we are not unified on that front. So we just file as separate taxes. Although if you are married filing separately, you need to put your spouse's information on there. Okay, you've got to give them their social security number, and then you've got to give them their identification. One of the drawbacks to marriage filing separately is that if your spouse itemized, then you also have to itemize. If they use the standard deduction, then you have to do it. You have to match what they are doing. Okay, so it's not a very good way to file taxes.
Gotcha. Great. Any further questions? We have Senior Servant, your hand is up again.
Yes, this is more of a contribution, not so much a question. Every year, my wife and I have been married for almost 30 years. We do file jointly, but last year I got a little creative and I wanted to file separately just for the heck to see what happens. We ended up, like Prof said, we ended up owing more. We ended up paying more than we should have paid. There's a way we corrected it, and I think, Prof, you can help me out here. It's called 1040X. We had a refile and told IRS, no, we made a mistake. Filing separately doesn't give us a lot of options, doesn't make us pay more than we should have paid. So the IRS actually refunded the difference because I worked the two and I said, look, if you had filed separately, if you had filed jointly, you would pay 1,000. Filing separately, we paid 1,200. So now we are refiling to jointly give us back my 200, and they did. But I'm not encouraging you to do that. I was just getting a little creative. I just wanted to test to see what the difference is. And like Prof said, it's not very healthy if you are married to do the filing separately. It's always best to do the jointly. So that's just some sort of contribution out.
Awesome. Prof, another question. It's when someone files like a joint filing with the spouses, but the one person also has a business on the side and combines both business and income tax together, is it advisable to do it that way? And what are the advantages and disadvantages of having individual or joint filing with business inclusive?
All right, so for the business taxes, depending on how you elected to be taxed as a business, you can either file it combined with your individual tax returns, or you can file it as a separate entity, right? So remember, when you were forming the business, you had to elect how you wanted to be taxed, okay? So you do have the option of filing with your individual returns on the Schedule C, or you could file 1120 for the business, whichever way you decide to do. My preference, if you want to know, see me in chambers because that's a paid service, okay? But my personal preference, right? Because think about business. If you establish an LLC, why did you establish the LLC? You established the LLC because you wanted the LLC to be a standalone business, okay? What does that mean in English? If there's any liabilities that is accrued by the company, your debtors can come after the company because the company is a standalone entity, okay? That's the meaning of LLC. You have that protection, okay? So when you file separate returns, everything that goes into the business is on the business. But when you start commingling the two, if there's anything that comes up in the business in terms of liability, they can come after your personal assets, right? So think about it. If you have equity in your house and your creditors are chasing you, and you've always combined the two and conjoined the two, all of a sudden, if the business cannot pay, they have the right to come after you. So every tax situation is different, but you could file as a business on Schedule C, and it will come on your 1040 as an individual. Your wife could also do the same thing, or you could file the business by itself and pay the taxes, so it's either or.
Thank you so much.
Prof, I have a question.
Go ahead.
So, you know how initially you talked about the W-4s?
Yes.
Before the tax reforms, I think in 2018 or like after 2016. Before that, this is what I personally did. Whatever job that I signed up for or I worked for, when I filled out my W-2 forms, I claimed 0. And I used that, as a form of savings so that at the end of every tax year, I would get a refund instead of having to pay taxes. Now, if I've kept the same job since, which means I haven't filled out a new W-4, is it still valid, or they got rid of the W-4 thing altogether to where you can't even claim 0? Like if I had to find a job right now, that there is going to be a standard deduction or withholding, I guess in this case. All right, thank you.
So for the W-4 that you filled prior to the changes, that same claims that you did, it still applies, okay? So even though the W-4 forms has changed, the tax withholding that you are seeing from your paycheck hasn't changed. It still remains the same, okay? You are probably paying higher because the way they've done the W-4 now, you could actually calculate how much you want them to take out of your taxes and break even, okay? It is simplified now, but it's a little bit complicated when you look at it and you don't understand what you are doing. Previously, when we had the personal exemptions, you could go and say, oh, I want to claim 4, right? I want to claim 3. I've got 4 kids. You could put that in, and that will reduce the amount of withholding that they withheld. But now you can go in and put in your filing status. You can say you are married filing jointly, married filing separately, put in all those things, and all those things get calculated for you, for them to take that right amount of withholdings, okay? If you file your taxes this year, for everybody who's on the call, if you filed your taxes this year and you owed money, the first thing that you need to do is to go back to your HR and go and review the W-4 again, okay? Because what I tell people is that the IRS is like a bank, okay? But this is a different bank. The difference between the IRS and a regular bank is that they don't pay interest on money that they owe you, but they will charge you for interest that you owe them. That is the basic premise of the IRS, okay? So if you owe them money, they'll charge you interest and penalties. But if they owe you money, they don't pay you any interest, So think about it as having this piggy bank, okay? The more money you withhold with them, the more money you get back. Simple. So if you look at your W-2 forms, I had a client about 2 days ago who had made $95,000 in box 1. The amount of withholding that they withheld for the whole year was $2,700. And he was calling me and asking me why he didn't get a refund. I said, I mean, if you calculate $2,700 or $95,000, it's not even up to 10%, that is so much less money. So you don't expect to get nothing back from them. As a matter of fact, you do owe them money because you didn't take enough from your taxes. So the box 1 and box 2 are so important. Box 1, amount of money you made in the year. The box 2 is the amount of federal tax withholding. If you go down to your W-2 to box 15 and you live in a state that charges you state taxes, then you see your state, it will say your state. Box 16 will say the amount of your overall income, and then box 17 and 18 will give you the amount of the withholding for the state, okay? And then depending on where you live, there are also local taxes. So after the state, then if you live in the city of Frederick will also take their cut. But if you live in a state like Texas or like Florida or Washington State, there are certain states that don't charge state taxes. So you will not see anything in box 15 through box 19. But box 1 and box 2 are very important, okay? So if you file your taxes and you owe money, please do not go to your tax preparer and tell them that, now, please stop that, okay? Because you are forcing them to do something that is not ethical. Go to your job and go and increase the withholding at source so that next year you don't go into that same problem again.
Awesome. Any more questions before we wrap up? Any additional questions that anyone want to ask, contribution, suggestion that you want to add before we wrap up?
This is David.
Yes.
Also to answer, please, can you, I know you said you didn't want to go into that, but with the student loan payment and then the adjusted income, can you tell us a little bit about it? Because depending on the amount you make, it doesn't matter how much you paid. Some of them, I mean, they will not give you any benefits for paying interest on your student. Can you please talk a little bit about that for us?
So the student loan interest deduction has a cap, right? So I believe, do not quote me on this, I believe it's up to $3,000, which is the interest that you pay on your student loan, okay? So it's up to $3,000 of interest. If you've had student loans before, those loans are so expensive, okay? Mine is about 7%. I hate paying student loans. That is one of the loans I hate paying. Maybe because I got a benefit 10 years ago or 15 years ago, and I don't see. But any interest that you paid on your student loan is deductible as an above the line item up to $3,000, okay? Of course, it has income threshold. So let's say you made income in excess of $400,000, right? All of a sudden, the government sees you that you've gotten so much benefit from the school that you went to and you're making $400,000. So you may not qualify for that deduction, all right? The income thresholds, I don't want to quote it, but I think it starts above $200,000 and then they start prorating it, okay? So let's say the income threshold is at $150,000. So any student loan that you pay up to $3,000, you can deduct it if you make up to $150,000. All of a sudden, if your income goes to $170,000, then you may be able to deduct $2,700. So that's what we call proration. If your income goes to $200,000, then you may be able to deduct $2,000. If your income goes to $250,000, then it goes down to $1,500, all the way till you get into the higher bracket, and then you are not allowed to deduct that interest, the student loan interest. It makes sense, right? Because the more money you make, $3,000 is nothing.
Is that based on the adjusted or still that is the gross?
So the student loan interest deduction comes out of the gross to give you the adjusted. It's part of the above the line item. So the gross, take out the student loan deduction, and then you get your adjusted gross income. So for those who have student loans with the government, as you all know, during the COVID, those student loans has been deferred, okay? And if you look at your student loan statement, the balance is still the same. So obviously for the last 2 years, you cannot claim that deduction because you've not made any interest payment. Any payment that you've been making for the last 2 years is going straight to your principal, okay? I had somebody on the call yesterday, and then they said, even though the government has stopped us from paying student loan, they were still paying. And I said, wow, that was a good idea. I should have done that. But as soon as the government told us to stop, I stopped paying, okay? So think about it. If you have $20,000 in student loan, and all of a sudden they're not charging you interest, any amount of student loan that you're paying is going straight to reduce that principal, regardless of what the Democrats and Republicans are doing. You don't care. You want to reduce that principal before they start charging you interest again. And that was a smart thing that the guy did, right? So they're talking about bringing it back in August. So in August, once we start paying those student loans, it's going to accrue interest, and that interest is deductible on your taxes.
Thank you. Before Senior K asks a question, there's another question. Doc, you had mentioned about how do you call it, a cap on child credits and child care. Can you talk a little more? Because I recall, I think last year or year before, you could get a lot of money from childcare and babysitting and stuff. But if I'm not mistaken, you had mentioned that they took that out or they've standardized it. What
So there's a child tax credit, and there's a dependent child and dependent care credit. Okay.
Okay.
The child tax credit is available to you if you have children under the age of 17. All right. During the COVID, in the first year of the COVID, they took it to $3,000. The standard rate in amount in 2019 was $2,000. But to help us, because there was so many people losing their job, they took it to $3,000 in 2020, and then they took it to $3,600 in 2021. All of a sudden, they've brought the child tax credit back to the pre-COVID levels, which is $2,000. So we had an extra $1,600 per child last year. That is no more. The dependency credit is if you and your spouse are working and you pay a daycare provider to take care of your kid, you can get credit for that, okay? I don't know why they put that in place, but I think they try to do that to help the daycare providers, to create jobs for them. That amount went all the way up to $8,000 in the past 2 years. So if you spend $8,000 to put your kids in daycare, let's say if you have 3 kids, right? One of my kids go to daycare, I can easily spend $8,000 a year. So last 2 years, I could have deducted up to $8,000, of course, based on your income threshold and everything. Now that amount has been brought down to $2,100. Okay, so that's a huge difference. So if you're paying for the child credit, the dependent care credit, and you think you're going to get back $8,000, that's not going to happen. And that is one of the reasons why your tax refund, if you've already filed this year, is much lower than it's been in the past 2 years.
Gotcha. All right, Senator.
Oh, I'm sorry if my hand is already was up, but anyway, Prof, thank you very much, Leo and Jake. Don't you all think that the congressmen, those who are making the laws, are probably not aware of what they are doing to us on the back end, and they probably need some accountants and actuaries advising them? Is there a way we can sort of get this across?
I'll leave that to Pro because he works with them, so he can kind of lobby for us to kind of
Yeah, because sometimes they come up with certain numbers and you just don't know how these numbers come across, how they arrive at these numbers. For example, in the corporate world, they just came up with a certain number that you no longer have to calculate any tax loss and any tax. You know how you do when you do your finances, you have your start and you have your taxes. You don't have to do any taxes. All you do is just calculate your start reserves and then multiply it by a certain percentage to get your tax reserves. How they came up with that number, nobody knows. So I'm not sure if they are really aware of what they are doing. And I mean, how can you drop something from 8,000 to 2,000? What is the justification? Is it being abused, or is it more people having less children, or people using less baby? I don't know. I mean, I'm just curious.
I don't want to go into the politics of things, but one of the biggest justification is that the country has a lot of debt, right? And all this money is coming out of the treasury. So the $6,000 difference, I mean, look at the number of people who can use this credit. All of a sudden, they want to kind of stabilize that. The other thing that I keep telling people, especially as the immigrants, is that we have to embrace this thing, all right? I'm a CPA. I've been dealing with taxes for close to 15 years, and I can't tell you that it's something that I like, but we have to embrace it. The reason why I say that is that, I mean, if you drive on the highway and you look at all those things that is going on in this nation, sometimes if you drive on this highway, the roads are not even messed up, and then they come in and then they redo it. You know, these are all tax dollars that they are using to do, right? So we have to embrace it, you know, pay our fair share. Sometimes it's amazing when I get calls from the Americans and how eager they are to pay. I had a client who owed about $35,000 and he was so excited to pay. As he said, I've saved money to pay these taxes. I'm like, there's no way, you know, a Ghanaian will be so excited to go pay $35,000 in taxes, right? So let's just embrace it. It's part of the system here and learn about it, you know, learn your 1040s. When your tax preparer prepares the taxes for you, ask relevant questions, look at the 1040. Okay, if they put in a medical bill for $15,000, ask them, because when the IRS come, they're going to ask you for the receipt. And if you don't have it, that's a big deal, you know. So
Okay.
ask relevant questions. Don't make it like an annual routine where you just give it to somebody and then they do it for you. If you decide to do it yourself using tax software, there's an option where you get somewhere and you don't understand, you click on learn more. So click on that, it gives you a breakdown. If you still don't understand it, there's an option where you can click on chat and chat to somebody who's an expert behind the scenes who will explain it to you, or you can call them or call me, and then we can set up an appointment to talk about your specific tax situation.
All right, Prof, thank you. That's just a little follow-up. I completely agree. It's a civic duty to do what is right, to pay the fair share of taxes, so that if there's a pothole near your street, you can call the mayor or whoever and they'll come and take care of it. That is all true. I agree, and I am very much pleased with that. But in one of our programs a while back, probably about 2 years back, my uncle, Mr. Asare from Prempe, asked something very similar to this. And the answer was that they can just sort of print more money. It doesn't affect, there's nothing that affects them, like, what is the right word? Inflation or whatever it is that affects a lot of foreign countries with money. America can do that without having any impact on their economy. I'm not a politician and I don't even want to discuss this, but I was just thinking out loud that if they can do that, why would we have to, if they can just print the money to do what they are doing, why would they have to, quote unquote, penalize the citizens for that? I mean, everybody is good. It's good to pay your fair share, but I don't think if there's another option, it should all be left to us. But that's just a discussion for another day. Don't worry about it. I was just thinking out loud. So,
Senior K, Senior SQ. This is David. Yeah, I have a take on that. Have you noticed the census numbers that came out? And have you looked at the breakdown of childbirth and stuff like that? Look at the people who are giving birth more. So it's purely, there is a racism connotation under all these things. They are not there.
Senior JK,
Yeah,
let's leave this for some
no,
other
you call a spade a spade. It's part of it.
No. This is not for this discussion. I know.
Yeah,
I was just trying to.
No, about the 8,000 to the 2001. That's what I'm saying. And they know it. The people is helping. So you should know that, you know, it's all part of it.
I know.
Yeah, and don't forget, always go back to the census. It will tell you everything. And I know
the man talking is a statistician. He's a statistics professor, so he knows what he's saying. But anyway, thank you very much. Thank you.
Awesome.
All right.
Awesome. If there's no other question, I will then hand over to Dr. Reiter to wrap it up for us.
Okay. So I think, you know, we spent a lot of time. If you still have questions, which I'm sure, you know, it's still possible. If you get in touch with me, I'll put you directly in touch with Prof. Or if you are on the AOBA North America platform, he's there, and you can directly message him. But like I said, if you contact any of the leaders, they will put you directly in charge with him. As you can see, he obviously knows his stuff. So if you have questions, don't try to, you know, figure it out on your own. Sometimes you save a lot of money when you let the experts handle it. You actually save, you know, in the long run. With that, I want to thank everybody who took the time to join this call. Without you, we have no program. So thank you very much on a Friday night, you know, for spending your time with us. We really appreciate and honor your time. To Prof, we are eternally grateful. I mean, putting all those slides and things together, we know this is what you do, but you still had to put a lot of time into it to make this presentation free of charge. I mean, these are some of the services that we go see our accountant and pay money for. So we are very grateful that you've given us this lecture and education for free. Thank you very much. Dr. Abe, as always, you're the man. Without you, this doesn't happen. So we are very grateful for this collaboration that we have with JAGILS. And we pray that we continue to do this. First, I mean, it helps our constituents both, like on both sides, and also, you know, all our guests who are able to join. So thank you all very much for joining us this evening. Enjoy the rest of your weekend. I think there's one more announcement. I think next week we also have another one coming. I'll post that on the AOBA platforms, and you definitely hear about it. But we're trying to match some of these, you know, line up some of these programs, healthcare, finances, and things like that to help everybody. So if you have suggestions, please reach out. If there's any topic that you feel you want discussed, please reach out and we'll definitely do whatever it takes to get experts to come on board and give presentations that will benefit everybody. So thank you very much and enjoy your weekend.
Thank you so much.
Oh,
Have a
thank you
blessed
so
day.
much. The access is so
Thank you.
Thank you.
Thank you.
Thank you.